A question that I get asked a lot right now is what happens if the Federal Reserve actually cuts rates later this year? Today, we're going to look at how we got here, what the Fed is signaling for the future, and most importantly, what does that mean for multifamily real estate? By the end, you'll have a clear understanding of where the opportunities may lie as we head into the next cycle. Let's rewind just a few years. Back in 2020, we were in an ultra low interest rate environment. The Fed dropped rates to near zero to stimulate the economy during the pandemic. Money was cheap, borrowing was easy, and naturally, we saw a flood of activity in the housing and commercial real estate markets. But by 2021, inflation started running hot. At first, the Fed thought it was transitory, but by early 2022, it was clear that inflation was persistent and spreading across the economy. So the Fed stepped in with the most aggressive series of rate hikes in decades. They raised rates all the way up to over 5% in just about 18 months. That was a shock to the system. For real estate investors, this completely changed the math. Suddenly, borrowing costs doubled or tripled, and valuations that worked at a 3% interest rate didn't make sense at 6% or higher. So where are we today? Inflation has been cooling. It's not back to the Fed's 2% target, but it's come down meaningfully compared to the peaks we saw in 2022. Inflation is still above target, but it's trending in the right direction. That's giving the Fed some room to at least signal that rate cuts could be on the horizon if that trend continues. Now, the Fed doesn't like to commit far in advance. They're what's called data dependent. Every decision they make is based on the latest economic reports. But right now, the expectation in the market is that we could see the first cut as early as September of this year. Most forecasts are talking about a 25 to 50 basis point cut. So not a huge move all at once, but a clear shift in direction. Once the Fed makes that first move, the question becomes, does it open the door to more cuts in late 2025 and beyond? Depending upon how the economy holds up, of course. That's where we're at today. The Fed has signaled they're ready to pivot if the data allows, and the markets are already starting to price that in. So let's talk about what that means for multifamily real estate. First, transaction volume. Right now, many deals are on the sidelines. Sellers still want yesterday's pricing, but most buyers can't make those numbers work with today's debt costs. It's created what we call a bid-ask spread. A rate cut could help narrow that gap. As borrowing costs ease, more deals will pencil out, and you'll see more transaction volume come back into the market again. Second, cap rates. Cap rates and interest rates aren't perfectly correlated, but they are related. When rates go higher, cap rates typically move higher as well, which means valuations come down. If the Fed starts cutting, we could see downward pressure on cap rates, which would support stronger property valuations. Third, valuations themselves. Right now, valuations in multifamily are under pressure because of the higher cost of capital. A lower interest rate environment could help stabilize valuations and in some markets even push them higher as demand from investors comes back in. Multifamily fundamentals remain strong. People need a place to live, and in markets with population and job growth, demand for housing continues to outpace supply. That hasn't changed. What has changed is the financing environment. A Fed rate cut would directly improve investor returns because debt becomes cheaper, deals start to make sense again, and competition for assets increases. For passive investors, this means opportunities you see in the next 12 to 24 months could become some of the most attractive we've had in years. If you are waiting on the sidelines, a Fed cut could be the catalyst that brings back both deal flow and investor confidence. Let's summarize. Number one, the Fed raised rates aggressively starting in 2022 to fight inflation. and that put a lot of pressure on real estate. Number 2, inflation has been cooling, and the Fed is signaling a potential rate cut as early as September. Number 3, a rate cut would likely increase transaction volume, put downward pressure on cap rates, and help stabilize or improve valuations in multifamily. And number 4, for investors, this creates opportunity. Multifamily remains a resilient asset class, and as financing conditions improve, we believe you'll see some of the best opportunities in years. Thanks for watching. If you want to learn more about how we're positioning ourselves and our investors for this next market cycle, visit our website at rise48equity.com. And if you found this helpful, make sure you subscribe so you don't miss future updates on the market and what it means for your investments.